All right. Well, welcome to Stock Market Review for this Wednesday. And of course, it's April 17th today. Great to have everybody here. All right. So markets coming down a little bit. I'm more concerned on Bitcoin right now. That has definitely come down quite a bit. And I think it's going to go down a lot further. So we're going to take a look at Bitcoin as well today. And we're going to also review the real estate situation as well. And interest rates. All right. Interest rates now are questionable about whether they'll bring them down again. And so I'll show you some information on that. All right, so let's go ahead and dive in. I'm going to cover, of course, first some risk control issues. You always want to make sure, of course, you take into account the risk part of trading the financial markets or even investing in the financial markets. And so you want to protect yourself as best as possible about the downside that you can occur when trading or investing in the financial markets. And so always trade with money you can afford to risk, called risk capital. That's really important. And then, of course, always make sure you calculate your risk on each and every investment or trade you make. That's also equally as important. And so we have a couple books that can help you on that. I'll show that to you in just a moment. Also put the links below for you if you want to get them that way in the recording. So I'll make sure all that's available. Also, too, check with your financial advisor. You know, we may talk about some possible stock opportunities here or even investment opportunities. We're going to go over some of our forecasts, but make sure these things are suitable for you. We don't know your personal situation. And of course, they certainly should and can advise you on that. All right. So also, too, on the books front, two money management books that I think everybody should be in everybody's library before they even begin trading or investing. And if you're already doing it and you want to improve your risk control, great books as well. I also got a book on Elliott Wave, which is a form of technical analysis. And then I'm working also on my latest book called The Art of Trading Second Edition, and that's on the far right. So that will be available probably at the end of summer, early fall, and you can pre-order that at any time. All right, so let's go ahead and dig into the economic calendar. I'm going to go full screen on this so you can really take a good look at it here. And in terms of important announcements coming up, since it is Wednesday already, we got crude oil inventories coming up. We're very bullish on crude oil. I'm going to go over that chart as well today. On Thursday, we got initial jobless claims, Philadelphia Fed Manufacturing Index, existing home sales. So we're going to take a close look at those. I'm very interested in the home sales as well coming up. And then, of course, a couple of little items have come out in the Wall Street Journal that I do want to share with you. So, you know, the inflation comes in hotter than expected, and that has basically thrown everybody off in the markets. The markets going into this year, we're expecting 6. Let me say that again, 6 rate cuts. And I think we'll be lucky if we get 1 or 2. At this particular point. It's pretty, I think the probabilities are pretty much in your favor. You're going to get 1 at some point, but I don't think it's going to be in June. All right. I think probably later in the midsummer, late summer, and then the other one's up for grabs depending on how the market is doing. This, we had one more announcement come out that I'll share with you in just a moment that basically talked about rates as well. All right, so in terms of trading the financial markets, we're going to be using a variety of software tools that I've created over the last 30 years of trading markets. We've got charting software, we've got scanners, we've got risk control software, all available. More information on our website. And again, I'll put a link in the recording down below if you're interested in looking at that as well. All right, so here's kind of an interesting thing. Let me just enlarge this as best as I can. So this came out today. Powell dials back expectation on rate cuts. It came out in the Wall Street Journal. It was actually yesterday that he announced this. And basically it says Federal Reserve Chair Powell said firm inflation during the first quarter had introduced new uncertainty over when and whether the central bank would be able to lower interest rates later this year. So there's many different ways to read that and interpret this. But this is basically saying that, folks, we may not get any rate decreases this year. So that threw the market as well. And, you know, interest rates on mortgages now have popped up with the fact that interest rates were kind of low, anticipating lower interest rates later. But with something like this coming out, now the banks are protecting their downside and have raised mortgage rates once again. So kind of interesting. All right, so let's dive into the latest charts. Now, this is a chart I did on Sunday for all our subscribers out there. And if you're not a subscriber, I'll put a link below that you can get this information over the weekend and be ready to go on Monday. But in terms of what I think is occurring here, I'm going to go over this daily chart on the Dow Jones. And then I'm going to show you also some of the other indexes like the NASDAQ and the S&P. But notice I've got numbers highlighted on this chart here. And this is what we call the Elliott Wave count. So in terms of Elliott Wave, it's a form of technical analysis. And there are 5 waves in both bullish trends and bearish trends. And they represent the swings that you see occurring in trends. So if you look at a trend, it's usually never straight up. It kind of goes up a little bit of profit taking, zigs and zags and zigs and zags until we get to the top of this wave 5. And then at that particular point, the trend usually ends and we get a trend in the opposite direction. So that's what the Elliott Wave numbers mean on this chart. Now, we've had a wave 3 top, and that was back in the year 2022. We had a pretty good sell-off that occurred and ended back in October 2023. And then we've been marching up, or actually October 2022, and then we've been marching up the entire year of 2023. And here we are in 2024. And we have experienced a pullback really since I think about April of this year. And we kind of anticipated that because look how strong this move up really was from October, straight up without too many pullbacks. That's unusual. So you usually can expect some form of pullback in the terms of profit taking at that particular point. But we've got another issue to contend with here at this particular point. Notice how close we came to the wave 5 target zone. We did not go in it, however, but we came very close to it. And in terms of statistical probabilities, 15% of the time, these wave 5s fail and do not make it to the target zone. So there's a 15% chance right now the market could just go into a bear market. But that's not the higher probability. The higher probability is the 70% of the time it goes into the target zone. So I'm always a probability person. I always go with the probabilities. So for this to really cause me concern that we're going into a bear market, we have to take out the October low. So until we do, I'm looking at any pullback in this area here, as long as it stays above its October low, is a profit-taking pullback. And normally what we do is draw fib retracements, which is another form of technical analysis that's based off the Fibonacci sequence. And that usually delivers a target zone of what we can expect for a normal profit-taking pullback. And I'm going to show you what that target is in just a moment on a different chart. So on this chart here, I'm expecting the market, the overall visual view, for it to come down something like this, turn around, and then head back up into the target zone. And then at that particular point, complete the bullish trend. And that I think won't occur and probably until late 2024, maybe bleeding over to 2025. But I do think probably we're going to see the market reverse and head up later this summer and be probably in the target zone right around election time. Okay. And then maybe after the election, we may see a sell-off. Okay. That's speculation. That's just trying to tie the sequences in to the wave movement. But it is a possibility. So in this case here, the higher probability, though, without the timing, is that we are going to pull back, continue to pull back some more, and then we should get another move and make a new all-time high in the markets. So that's the forecast right now. That's the highest probability one. All right, now, if we are in this profit taking, which I'm pretty sure we are, we should get down into this target zone here. Now, this chart is a 60-minute chart, so it's considered an intraday time frame. And every price bar represents an hour in this. And so the reason I use this is because this would be a wave 4 pullback inside that wave 5 that we still think we're in on the other chart. And so this is kind of a more advanced way of looking at Elliott Wave, because there are 5 waves inside every impulsive wave that moves in the direction of the trend that you're measuring. And so this kind of gives us an opportunity to put the entire trend under a microscope that we're looking at and get more exact on where this thing is going to pull back. And so that's what the purpose of this chart is. And so my target for this profit taking pullback is anywhere between 37,580 down to 36,150. All right, so we're getting pretty close to that. And as of the current time right now, it's about 37,688. So we're knocking on the door right here. And I'll show you the live charts in a moment, but we're knocking on the door of that profit taking zone. So this is a fib retracement, like I discussed before. And that fib retracement is between 38.2 to 61.8%. So that's the target range. So I would expect it to get into that range. And then we're going to have to see where we have positive momentum coming back in. And that will usually indicate that the profit taking is over. So a little bit more to the downside coming in here. I think over the next several weeks, maybe months, okay, it depends on, I wouldn't be surprised if we get a pull up and then maybe another move down, and that will delay the time it takes to get into that target zone. So we're going to have to see what happens here, but we've got very bearish momentum. This is one of our indicators called an OWL, and that stands for optimum wave locator. And that's pretty bearish at this point. So when we see that, we know we have negative momentum still in play. And notice our pyramid trading points captured this move down pretty early, and then it escalated from there. So all things point to a move down, and I'm calling this a profit-taking situation. So that's kind of where we're at now. And this could be a decent buying opportunity for one more leg up if you are a trader. If you're an investor, the upside potential, you have to time it right. So it may be a little bit difficult for you as an investor because you're not looking at the markets all the time like traders are. So you got to be careful, I think, at this particular point. The next high in the markets, you need to be talking to your financial advisor about a game plan in case the market then rolls over into a bear market. So kind of have that on your radar screen. All right, I want to keep going on here and talking a little bit about the real estate market as well. And this is the Case-Shiller Index versus the CPI, which is the Consumer Price Index. Now, the Case-Shiller is highlighted in red. So let me just mark that as Case-Shiller. And this is the CPI, and we show this every week. And the idea behind this is we're looking for changes, and we don't see one yet. So the CPI measure is a basic measure of inflation. And based on this, if we go back into the 1970s, certainly buying a home, all right, is going to keep you above the CPI, which means that it's going to stay slightly above inflation. So the homes have always been looked at as a good investment for that reason. And then, of course, there are tax benefits you get. You can, write off mortgage interest. If you have rental property, you can do that as well. And if the interest rates are low enough, okay, for those investors out there, that even creates a bigger spread for profit. Okay, so the lower the interest rates, the less the carrying costs of an investment property. So let's analyze kind of what happened on this. And you can certainly see that basically when the Case-Shiller and the CPI are fairly close together, that is ideally the way you want it to be, because that is a very proportionate, measured, and balanced, okay, trend that both housing is in and inflation. And so we had that for the most part for many, many years, from 1980 to 2000. Then interest rates got cut. All right. And if you remember back in the years where the markets took off, the mortgage business changed. There were some laws that were changed in order to make mortgages much easier to get. But also, too, in the investment arena, this was a period where the lenders didn't really care that much about income and cared more about the value of the property and writing as many mortgages as possible because they were securitizing them in the secondary market. So this was a boom, all right, in lending in terms of easing the qualifications in order to package these mortgages and into securities that they could trade. And that was something that came along at the time, around 2000. And you can see how the interest rates were fairly low as well. It fueled, okay, it absolutely fueled the housing market. And so basically, if you could breathe, you could get a mortgage back then. And secondary mortgages were a big deal too, the HELOC mortgages, those were your equity mortgages. So there you have it. And then you had a situation where the Case-Shiller got very far away from the CPI. When that happens, that's called a bubble. And so we had that bubble start around 2006, all right, and then it started falling apart around 2008, 2007, 8. And that's, of course, the financial crisis. And that's where all those mortgages that people couldn't qualify for were being defaulted on because times got tough, people got laid off, and housing had to come down at that particular point. And the bubble burst, which is healthy, all right? And then we got fairly close again and proportionate to the CPI. And then the markets found value and they went up again. And even interest rates now are lower because you had a recession here as well. And so the Fed was trying to basically stimulate the economy. So it lowered rates. And of course, people like that. The economy improved and jobs became plentiful again and people could afford homes and up it went. Then we had COVID, all right, in 2019. All right, stimulus money came in. People didn't have to pay their mortgages. They were kind of put on hold until after the pandemic. And interest rates went even lower to help people out. And then you had, because of the pandemic, you had people moving away from the city into the suburbs, which created even more demand, and housing has taken off. And here we are in 2024 at an all-time high in housing, but look at the spread between the CPI and the current Case-Shiller index. Huge. And you can note here on the CPI, the increase in inflation. Notice how it's gone up a little bit, but so is housing. So if you believe in history and the fact that markets do correct and do pull back to their norms, then you've got to believe that eventually home prices need to drop about 40 to 50% in order to come back in line with the CPI. So that creates a kind of feeling of not a matter of if the housing will bust, but more a matter of when. All right, so we're going to keep an eye on that, but this chart is indicating once again an extreme bubble, even worse than the one that occurred during the financial crisis. And it's a great one because you can visually see how extended home prices are. Now, if we go to our next chart, let me enlarge this one a little bit for you here. This chart is done by RE Venture Consulting, and basically it's home value to income ratios. And this was done back in the summer of 2023. I'm hoping they'll update this in 2024. But back then, what happened is they plotted this thing. It's really kind of a great chart, but this is the financial crisis. I'll put FC here, where basically home prices got far enough away from the average income, which is indicated down here by this yellow dotted line. And so people couldn't afford homes. And therefore, once they can't afford homes, then of course, you have a bubble. And that particular bubble was, of course, all about the no income mortgages and the bad mortgages they wrote. All right, so then now here we are sitting here at another bubble where we've had excess stimulus, thanks to the Fed, to keep the economy humming along and not busting. And now we've got a situation once again where home prices are way out of sync to income. So again, kind of like the graph I just showed you, we are in bubble territory. So here's another another graph confirming or at least supporting the fact that we're in a bubble. And this one is for incomes. And then our next graph I want to show you here basically takes into account debt for debt to income ratio for home buyers. Way out of sync again. All right. And we're in another bubble. And I think this was, again, done in 2023. And right now, credit card debt is at its all-time high. So this is even worse. So back here, it said basically it was 40% compared to where it needs to be. And so probably it's even higher now. So these are all pointing to a bubble in the real estate market. And again, it's not a matter of if, it's a matter of when. So keep that in mind, that and times are not different. Okay. You always hear the statement, well, it's different now. Not really. Okay. Every bubble, they say that. And the more they say that, the more you're close to the end of the bubble. So keep that in mind. You know, in terms of housing right now, I see a big potential pullback occurring, but I don't see probably occurring until after the election. And I probably could also be occurring with the stock market. And if we have a recession, of course, that will do it in too. All right. So I think I just want to cover that. Also, this spring, new listings are coming up. All right. So that is increasing the supply. Real estate's very local. So it depends on your area. Some areas will hold their value better than others. So you do have to take that into account when you're talking about averages. But there's more listings coming on the market. But there's also not a lot of sales still occurring. So you're not seeing a lot of sales activity. So even though there's more listings coming on, they're at high prices. And I think the demand at those prices are not what they need to be to create the kind of activity you want to see in the real estate market. So I think the more houses that flood the market is actually supporting the case for prices coming down. All right, so kind of keep that in mind as well. All right, so I want to leave here for a moment now and go to the live markets here for just a moment. And I want to first talk about Bitcoin here. So this is, notice I'm going to just go over the charts here. This is a 60-minute chart. We look at the short-term view here, daily chart for the intermediate term, weekly chart over here for the long term. So that's why I have 3 charts up here. This is our scanners. I'm not going to go over those now. So in any case, we were hoping for one more high in Bitcoin, but that is not happening. So this is a wave 3 top at this point. We're going into the wave 4 profit taking area. So I think Bitcoin has a good possibility of reaching into the 50, below 60, and then possibly to the 53, 382, 40, 484 level before it comes back. Now, make no mistake about Bitcoin. If you look at the weekly chart, very strong market. So this indicator here has a 75% probability. And how you use it is you take it the highest price in the green area. And so we should make all time highs, more highs in Bitcoin eventually. This is also green. But I think you're going to have to struggle through a pullback here before we see those. And so I'm looking at this pullback probably stretching over another month or 2 as we pull back into this target range. And then after that, we should see some buying coming back in and actually making new all-time highs on Bitcoin, reaching 82,000 to possibly 95,000 on its next swing up. We'll see where this thing ends, but that's kind of where the ballpark is, and it may not reach that until late 2024. So we'll see, okay? But a little bit more pain to the downside, I think, on Bitcoin, and you can see it even on GBTC as well, which is the ETF for Bitcoin. All right, a couple of things I do want to cover before we close out here. USO is the ETF for crude oil. My target on crude oil is anywhere from $100 to about $110. Should be reached, I think, this summer sometime. So that's where the fib extensions are working out to. And we're kind of on its way up. So we recommended this as a buy earlier this year. And so it's done pretty well. So I think you should be pretty happy with that. But I don't think it's over. All right. And it will zig and it will zag. You'll have a little profit taking, which is kind of what's coming here now. But I don't anticipate this bottom over here, okay, to be breached. I think a little profit taking, and then we move back up. So we're bullish still on oil. All right. Gold, of course, has been doing really well and continues to do well on this. My target is 220 to 240 on this before we see a pullback. And we're right around the 220 mark right now. All right, TLT, which is the ETF for bonds. All right, so now I know Harry Dent, I know a lot of people are recommending the bond market right now. I'm kind of holding off here. I've got a red PTF still on the weekly chart indicating the bottom is not in on bonds yet. I will be all over bonds when the bottom is in and we see a turnaround, but right now, not the case, okay? So I'm not recommending bonds at this point. Let's see if this bottom here holds and then if it gets pierced or not. So I would not touch it right now, and currently it's selling off. So there's no reason to go into that. All right, silver, we're bullish on silver. We recommended silver when we had the pyramid entry down here and the breakout of the pennant, and it has soared, okay? It's gone from roughly our 21 entry price up to 26 in a very short period of time. And basically, this is still on a tear to the upside. Yes, we're going to get a correction. Markets don't go in the straight line without a correction. So just like in Bitcoin, we'll get a correction and then probably another move up after that. I don't think I would buy silver right now. Wait for the correction. Be a little patient, and I think you can get a much better price at some point, okay? So I think that's kind of the way I would play that. All right, UNG, last one I'm going to look at today before we call it a day here, because I like to keep these at about a half an hour. All right, so this is natural gas, all right? And it's, at a new bottom here, but it's not bottoming. We have a red PTF on our short-term chart, so it's still going down. And as soon as it bottoms, this is going to be a fairly good long trade at some point, but not yet. Not quite ready yet. So hang tight with UNG. I would not enter this. In fact, it's been a great short trade for quite a while. All right. And at this particular point, close to a bottom, but not quite there yet. So, a lot of correction going on in the markets right now. And I think we can kind of see a little bit more of that for the next maybe month, maybe two. All right. Depends when we get down into that target zone. But basically, if we look at some of the, let me just quickly look at the S&P index before we go here and take a quick look at that. So let me go to the indexes here and bring up the S&P 500. So on the S&P 500, we can get that baby to load. All right, that doesn't seem to be loading. And let's try the NASDAQ and see if we can get in. Yeah, those markets don't seem to be loading. I don't have the data loaded on those, but they're very similar to the Dow, okay? So you can pretty much count on those following the Dow. They have not hit their target zones yet, so that's kind of important. We should look at CBT one last time. This is the market for the real estate housing. And, again, it's the interest rates. You can see where it was moving up before the interest rates were announced that they're not going to be cut. And you can see a sharp move down. So that is definitely affecting the entire real estate market, including the REITs out there as well. So things don't look good for real estate. We may finally start to see a tick down in prices. Okay, we'll have to wait and see on this. All right, so that's it for this week. All right, I want to thank everybody for, of course, tuning in. We'll be back next Wednesday. Now, if you're our clients, we have the client support webinar coming up in about half an hour for all our clients. So please, I hope to see many of you there. And then on Friday, we have Stock Analysis Friday, where we're actually go over stocks there. And that's a great place to bring your stocks. I'll give it a view using our software and technical analysis and tell you what I think is going to happen with those. So hopefully I'll see most of you there on Friday. We usually have a really great turnout on that one. All right, so have a great week, and we'll see you back here next week. Thanks so much. I'll put a little bit of music on, go full screen again, and we'll see you next week.